And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Good morning, I'm Danny Ratliff here with The Real Investment Show. You may be thinking, what is going on? Lance looks younger, more handsome. That is not correct. Lance is not here. And so as I will tell my kids, as Lance texted me at 4:45 this morning, unfortunately he's ill, hopefully getting some rest. It says he's lost his voice, but I'm a planner by nature. Lance can get up and talk all day long. So today's show, we should be titled, Brent, you get what you get and you don't throw a fit. Just like I would tell my kids, because as a planner by nature, I like a little more time than 4:45 a.m. to jump up at 6. But
so
here we are.
today's show is the luck of the draw.
Ah, yeah. Did you have your lucky charms?
There you go.
Yeah. So big day today in markets and the economy. Fed meeting. I think the market's been on pins and needles waiting to see what is next. And really, it's the verbiage and what comes out after the meeting. What's the dot plot look like? What is Fed Chairman Powell going to say? I don't think much will change from here. Markets a little bit muted here. Good day yesterday. Treasury yields did drop a bit. Markets were up a tad. Today, futures a bit ago were pointing down. Yields were down a bit as well, so bonds were up. Kind of interesting because we haven't had a whole lot of data that suggests that we're going to get these cuts. And if you guys can recall from the beginning of the year, there was a lot of anticipation that the market had priced in 5 to 6 rate cuts. And so when you think about where the Fed has been and saying, hey, we're going to look like 2 to 3 is probably more likely. And I think that's still going to be the case. Fed Chair Powell's likely going to come out and say, hey, this hasn't changed. We're still on track for 3. Maybe the big verbiage change could be, and I don't think he's ready to rock the cradle too much yet, is they go down to 2. Because economic data, if you look at CPI, PPI, it's still been rather resilient. There's a lot of things going on here at once. And I don't envy their position. You know, if we ever talk about the Fed, that is an extremely difficult job. However, they're dealing with data that's in the past, data that's likely going to be revised. There are a lot of moving parts that these guys have to deal with. And so we have to take that in consideration. And they have a tendency to not be real right. And so I don't put a whole lot into, these day to day. I think that's going to be more short term. Things will change. Obviously, as they have used the word transitory, we'll likely see that this yet is transitory once again. Now, is that good or bad, and what does that look like? We'll find out later this afternoon. But that's probably the biggest news we have out right now. Lots going on with, we've seen mortgage rates pop back above 7%. Earnings, we have Chewy, Five Below, General Mills, Guess, and KB Homes. KB Homes is probably more interesting right now, just kind of getting an understanding and a feeling for the home market. Mortgage rates above 7%. Once again, it's difficult. I mean, we think back to where they were just a year and a half, 2 years ago, and the cost of entry to a new home is just through the roof. Most people can't afford it any longer. And we're really seeing, people getting priced out. I've talked to different developers and different people, and as they're running numbers, they're looking at, we can build a luxury home, or we can build a small multifamily or duplexes. It's nothing that middle America is typically used to, because you just can't spend $400,000 or $500,000 on these homes. It's kind of interesting. My in-laws are actually moving back towards the Houston area, and they're looking at homes, and they said, "Would you guys go take a look?" And they said, so I went and looked at these houses, and I said, "What do you think?" I said, I think this home 5 years ago is probably half the price. It's crazy. But that's just what the going rate is. And so people are frustrated. I think that things are likely going to change over time. But, outside of today, there's not a ton of big economic news. Tomorrow we'll be looking at the Philadelphia Fed business outlook, initial jobless claims. I guess there are some big things going on. But those are going to be some of the bigger ones that we have towards the end of the week. Friday, no notable economic data. So pretty lame as far as towards the rest of the week. But we are going to get into a handful of different things today. So Social Security, as Brent so nicely put, is your ex worth more dead than alive? And we're going to talk a little bit about Social Security and what that means and why that actually may help some people. And do you know what a qualified default investment alternative option is? That's a mouthful. That is target date funds. Yesterday, I had actually two different questions on target date funds. And every now and again, you guys will hear me go on a rant about these. We're going to talk a little bit about these and what exactly they are, how people use them, where they're most commonly found, and the goods and bads. There may be a little bit of good. I don't like them a whole lot, but we'll talk about it. And then yesterday was the first day of spring. So a little bit of spring cleaning, as Richard Rosso would say, the financial dust bunnies. As everybody's cleaning the garage and the house, what should you be looking for financially to clean? And so a lot to get into. And I will also be looking to the live chat on YouTube. So if you're not on YouTube, go to The Real Investment Show. If you guys have something you want to talk about, some topics, happy to jump into it. As I mentioned earlier, kind of winging this morning, as Lance is out, unfortunately, laryngitis, bronchitis, something of the sort, having a difficult time talking this morning. So hopefully he gets to feeling better here quickly. But also, mention Social Security. We do have like one spot left in our in-person, in-house Lunch and Learn today. So the two Johns, Jonathan McCarty and John Penn, will be presenting. Richard and I will also be in attendance with Sarah Binger, our in-house financial guru, today. And talking about Social Security, what should you be doing? How do you do Social Security planning for couples specifically? And so we know there's a lot of thoughts around Social Security, a lot of concerns with, is it viable? What's the solvency look like? When do they run out of money? Knowing that, should you make changes? How do you plan for that? How do you take your distributions or your benefits, to make sure you get the most out of it? And so we do have one spot left for in-person. Go sign up at The Real Investment at realinvestmentadvice.com. We would love to have you. This is an in-person event here in Houston, Texas. So this is not online, not a webinar. But Brent, we were talking about potentially trying to record something here in the not so distant future, but having a little bit of trouble with our cameras today. So probably won't happen. But Brent, so what are you laughing at?
You got 45 seconds to the break.
Yeah. Well, like I said, we're winging it.
It's okay.
You tell I'm struggling?
It's all right. It's first segment.
So, did you have a good spring break?
We did. We escaped, went up into northwest Arkansas, southeastern Oklahoma.
Yeah.
A little bit of a road trip, saw
right.
family and friends. Good times.
That's good. That's good. We went and saw my alma mater go beat Lance's alma mater, which is pretty common with most things between Lance and I. But in baseball, and then did a little trip with the kids. So that was good. It's good. All right, we get back. Why is your ex worth more dead than alive? So stay tuned. We'll be right back after this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff, filling in for Lance Roberts today. Unfortunately, he is out, so you're stuck with me. But we're talking a little bit about, is your ex worth more dead than alive? And goodness gracious, Brent, is this not a topic for Richard or what? We should have saved this for Friday because I think he'd have some fun with this one.
It's a little clickbaity, but
Yeah, a little bit. A little bit.
might want to explain where you're going with that.
We'll let people wait. And pins and needles, right?
Yeah.
No. So Social Security benefits. After divorce, in some cases, your ex is worth more than or is worth twice as much dead than alive. And really what that means is, let's talk a little bit about Social Security and how that works for couples in general. So let's say that maybe you have a homemaker, somebody who stayed at home, or somebody who did not make nearly as much income as the other spouse. The breadwinner, and I'll just give you a quick example. Let's say that their benefit was $2,500 and the other spouse's benefit's $1,000. They will get a spousal benefit on top of their $1,000 to make it half of what the breadwinner's Social Security benefit is. So bringing it up to $1,250. So essentially, those benefits are worth up to 50% of the breadwinner's value at full retirement age. So pretty neat benefit here that helps a lot of people out. In fact, I've talked to a lot of couples in the past that they don't even realize that the spouse is eligible for Social Security. Maybe somebody didn't work at all. They stayed home. They didn't have any of the 10 years or the 40 quarters that you have to put in to qualify for Social Security benefits. And this is a big, big benefit for many households. As you know, if you don't realize that, you get some free money. That's fantastic. Now, I say free, somebody's put into that over time. Now, the caveat here with your ex being worth more dead than alive is that you'll get your benefit and you would get half. Now, if you're married, so that same example, and the breadwinner passes away, the spouse who was collecting $1,250 now collects $2,500. The same goes if you're divorced. Now, a couple things here. If you're divorced, you have to have been divorced you have to have been married for at least 10 years. So there has to be a 10-year time frame that you have been married. The claimant must also be at least 62 years of age and must not be remarried. So 10 years, not remarried. Now, we've known people in the past trying to get around the system saying, hey, I will not remarry because they they want to collect on maybe they had a high income earner as a spouse and they want to collect those benefits. Now, the other caveat is the couple must be divorced for at least 2 continuous years. So a couple moving parts here. Have to have been married for 10 years, have to have been divorced for at least 2. Claimant must be at least 62 years or old and must not be remarried. But that enables you, or you're eligible for, up to half of their Social Security at that point. And now a lot of people will say, well, I'm taking it right now. I'm going to get as much money out of them as I can. Your spouse will never know. They'll have no idea. So, it's as good as, or maybe as good as that makes you feel, it's not going to negatively impact your spouse. They'll never know that you've taken it. They're never going to have their benefits decreased. So make sure you consult with somebody, preferably somebody who has a lot of expertise with Social Security, to point you in the right direction and make sure that you're not leaving any money on the table. And so when that ex-spouse dies, though, you'll be eligible for survivor benefits. So the other caveat here, so we'll throw one more out there. The benefit formula changes a tad bit. So you would be eligible for 100% of the decedent's or the ex-spouse's benefit. Now, remarrying after age 60 won't affect your eligibility for survivor benefits. Remarrying earlier disqualifies the eligibility. So one more thing to throw out there. So I wish I had some bullet points here. If I wasn't notified at 4:45 this morning, Lance, we could have some good information here for you that Brent could put up on the screen, but that's okay. We're going to give him a hard time until he feels better at least, or probably always. But if you still have questions on Social Security, go to realinvestmentadvice.com. Go to Ask Questions. We'll be happy to answer any of those. We do have, so John Penn and Jonathan McCarty are National Social Security advisors. They just attained the certification not long ago. They'll actually be doing our Lunch and Learn today, and happy to answer any of those questions. There's a lot of questions on here I'm trying to get through on YouTube here. Some pretty good stuff here. Do a checkup on my exes, man. All right, question. Have you been seeing that more retirees and those looking to plan for retirement incorporate an element of inflation hedging in their portfolio plan? I do think that we see quite a bit of that. I mean, so depending on how you're referring to hedging of inflation, and whether that means through a type of investment, are you looking at a floating rate fund or some type of tip? We do see people utilizing that. But I think the big thing with inflation within financial planning is making sure that you're using realistic numbers. And, it's difficult sometimes, especially when we saw years like we've seen over the last several where you've got upwards of 20% inflation cumulatively. That becomes much, much more difficult than what we have seen where we've had really anemic, very slow, low growth type of inflation. And so we do, but we need to update that and kind of look out on a longer term. What is it likely to be? Is this the 1970s all over again? I know we hear a lot of stories about that. I don't think so. But are we maybe stickier than we anticipate? I mean, clearly we're there right now. Now the Fed's, they're talking about cuts, and I do think we'll likely see that. I mean, we've seen this 10-year Treasury yield bounce around quite a bit. I think we'll continue to see that for some time, and especially right now with the market digesting, understanding, are we not doing 5 or 6 cuts? It's likely not. So we've seen yields pop back. Things were overextended, oversold on rates. I think that, we're seeing them go the opposite direction for a bit. And then we'll get to the other way, right? Where we're going to see yields drop. The Fed will say something, the dot plot will change, or we get economic data, which I think that's what they're going to say. We need more economic data before they do anything. And things will be changed. And so hedging for inflation, I think, is really important. Understanding how you hedge from a portfolio perspective, but then also within your financial plan, having some type of inflation in there. When we do a plan, we will have data. And essentially what we do is we put it in it where it looks like you are giving yourself a raise each and every single year. So every year you assume that you're going to collect more money. The issue is that I've never had a client come to me. In fact, I had somebody yesterday mention to me, say, well, Danny, in our financial plan, you have that we get a raise. Did I get my raise this year? I'm like, no, we didn't. You didn't get that raise. Do you need more money? No. Okay. So we do that to assume for higher and more inflation. But I've never had somebody come to me January 1st say, I need that extra 3% or whatever it is that we're assuming for inflation. And that number's changed over the last several years where we've increased it. Did so a tad bit before we actually saw, this hyperinflation that we've seen here. But we haven't done it to the extent of what's actually happened because we don't think that's sustainable for long periods of time. We don't think we're going to see this hyperinflation that we have. Now, is it stickier? Absolutely. But planning for it, I think, is important because if we assume that you're going to give yourself a 3% raise each and every year, yet you don't, I think that gives you a little bit of wiggle room. Our job is to stress financial plans. And what I do see, though, is every, say, 3 to 5 years, somebody comes up and says, hey, as we're reviewing financial plans, how's everything going? How do you guys feel? And usually one spouse says, man, I feel like we're living paycheck to paycheck. What can we do? Can we afford to take a little bit more out? So, yeah, we've been planning for this within your financial plan. But that is where I think it's super important. And that's something that you need to make sure you're utilizing within your plan. And then stress it for numbers as well. We've seen portfolios that have really jumped around quite a bit. It's been a challenging market environment. It's as good as what the market has looked like even last year. On the surface, you look underneath, and if you're not invested in the NASDAQ or the S&P, it is a completely different story. And not to mention, you had 2022, which there was no place to hide but cash. Stocks down, bonds down. Extremely difficult environment for investors. And then we have a year like last year where the indexes are great, but the problem is most people aren't only investing in the equity indexes. You're invested in many different areas that are underperforming compared to those indexes. And bonds have still been struggling as rates have been relatively high. I mean, we've seen them much higher than where they are right now, but they're still high. So it presents a challenge. So I would also, if you're going to look at your plan, I would say, how should we be looking at this from a return perspective? I see these long-term returns. I read an article this week actually in Market Watch, and they were talking about what if you'd invest in these different types of portfolios over the last 60 years, if you put $100,000, here's what your funds would be worth. And actually, I think it was longer. It's going back to like the 50s. It's like, well, that's fantastic, right? You put $100,000 in the 50s, which most people didn't have. You take inflation. $100,000 was a ton of money back then. And you would have, 20 some odd $1 million right now had you just bought and held. The problem is most people, number one, can't just buy and hold. Number two, they don't have that time frame because let's think about this. We may be investing, we're putting funds aside little by little over time, and you're taking advantage of those markets' ebbs and flows. Now, the problem is once you get into distribution planning, you can't face those really negative down years. And so we'll talk a little bit more about that on the other side of this break. But how do you look at that from a planning perspective, from an inflation, from a return? We'll be right back after this break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I learned a very valuable lesson yesterday, Brett. You know, my wife had a really hard day at work, and she came home, and she was a little bit stressed out. And I said, well, honey, I'll take you to go get a scoop of ice cream. She said, no, I can't. I'm too fat. That's where I made my critical mistake.
The Real Investment Show podcast.
I said, okay.
Same show, your schedule.
Then I realized at that moment that I'd made this crucial mistake, which was I should have said, no, you need to get 2 scoops because you're too skinny.
At realinvestmentadvice.com.
You need some ice cream. Go eat a cheeseburger.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff here for Lance Roberts today. So I had a question on the YouTube channel. If you are not a subscriber, go to the Real Investment Show, hit the subscribe button and hit the like button, because I am going to give Lance a lot of grief tomorrow when he comes back, when I can say, I looked at yesterday and we've got more likes. So you can help me give him a hard time, which will be a lot of fun. So did get a great question earlier. It said, have you been seeing that more retirees and those looking to plan for retirement incorporate an element of inflation hedging in their portfolio/plan? And so there's lots of ways to do that. And I want to just tie this up a little bit and kind of finish that thought, where, you know, we talk about how we do that within a financial plan by inflating what you're actually going to be distributing in retirement. We also talk about different ways that you can hedge. You know, a lot of people use gold. A lot of people use the markets. A lot of people use, commodities. There's a number of different ways that you can do so. Tips, I-bonds. I-bonds were great a while back. Those numbers have fallen quite a bit, but still not terrible. A lot of this inflation investments, though, depending on what you look for, are only going to keep up with inflation. So you basically just maintain your purchasing power. I mean, if we keep money in a savings account, we're never going to keep up with inflation, essentially, right? Because we know that bank is never going to pay us the exact same amount what inflation is, because they are trying to make money on your money. And that's why we advocate on a regular basis on taking funds out of those big banks, finding a bank that is still FDIC insured, but it's going to pay you to keep your funds. Because let's face it, they're using your money to make money. You should too. So, but talking a little bit about, inflating numbers, looking at returns. And when we look at a financial plan, what does that mean? What are ways that we can do to take all these things into account? I know there's a lot of worries and concerns right now, right? Markets have hit an all-time high for the 18th time this year. And they typically do so in bunches. We do see that happen, relatively quickly. Now, that doesn't mean that we're done either. We are in an inflation year. Typically, an inflation year, we do expect good returns. We have a lot of money still out there in the markets and the economy. Lance has mentioned that the buyback window has shut down now, so that's a little bit of a concern. And what really probably that means that we'll just see some more volatility here moving forward. VIX has been up slightly. I think we're going to continue to see that come in a not so distant future. I mean, we've seen a little bit more of that volatility. The Fed could spark this, just some of the verbiage that they say. But, we're waiting on kind of bad news because what we want is the Fed to cut. And it's really interesting that we need this Fed cut, yet, are they doing so to thread this needle for that soft landing, or are we doing so because we have devastating economic news? But the market seems to not care. They just want lower rates. And so we have to be mindful of that. But we also need to think about what happens if we do get into that bad environment again. This has been a challenging market, as we talked about last segment, in the sense that we just haven't seen this. If you look at a chart, especially extended out, it looks pretty good. And you do see this upward trend, no doubt. But there's some valleys within that. There's some negative years, some challenging years. You go back to 18, and it has not been some cakewalk where just the markets have just gone straight up. There's been, some problems within it. In 18, Jerome Powell, when yields were at about 3.25, and we had coming off two of the best consecutive earnings revenues quarters we had seen in Q2 and Q3. We saw Jerome Powell come out and say, hey, we're a long ways from neutral. We're going to start hiking interest rates. And at that time, you had thought, okay, that may sound normal, right? We were coming off the Tax Cuts and Jobs Act being enacted. Corporations, a lot of that was a function of them just having a lot more money in their pockets. It really made their numbers look good year over year. But what happened from there was that the market crashed 10% in October. And I think it was November 8th of that year that Powell came out and said, whoa, we are done. We're not going to hike anymore. And at that point, you would have thought the market would go back up. Nope, went down another 10%, basically erasing one of the better years from an economic perspective that we probably have on the books here for a while. And goes down another 10 to be the worst fourth quarter we've seen since the Great Depression, down 20%, Q4 of 2018. 2019, get a really good year. 2020, getting the pandemic, see a 36% drop. Another humongous challenge. But markets end up recovering, a lot of that being on meme stocks and some of these more speculative investments. And many people at that point were saying, oh man, I don't know what's happening. We're just trying to figure out, where we're gonna be, what we're doing. People are scared. A lot of people, unfortunately, remove themselves from the markets. 21, great year. 22, another extremely challenging year. And here we are in 23, a really good year on paper, but many people didn't keep up with what those overall returns were. And then same for 24. I mean, we've seen it where market breadth has remained relatively poor. It has not been just this great market where everything's advancing. Now, we've seen moments, glimpses here where it's looked much improved, but we haven't seen it where it's just been where you would expect when you look under the hood and say, wow, everything's pretty healthy. It's not the case. So we talk about inflation hedging. What about when you see this inflation hedging and overall, how do you do it? What do most people do? And so I think that goes back to the plan. We've got to keep that into account. But, right now we're going to see, if we're looking at higher taxes, President Biden's throwing out raising corporate tax rates again. That does not just impact corporations. That comes down to you and I, to everybody else. They're going to go after business owners. So you think about some of these small business owners, we know many of them that do very well, but they eat, sleep, work. It is nonstop. There's a lot of blood, sweat, and tears with many of these people. And they have built something from the ground up. And they're going to go out and penalize them, who also, guess what, hire a lot of people within the economy. We've seen shrinkage. I mean, we talked about, in fact, President Biden did this in State of the Union just last week, talking about, how the Cookie Monster's upset because there's not as much cookies in the bag. Well, that's right. That's what happens. So what corporations are doing, typically they're always trying to make something bigger and better, but now they're having to say, well, we're going to have to eliminate a little bit of this. Shoot, Wall Street Journal said to keep up with inflation, maybe just last week they said, maybe you should skip breakfast. So we do have an inflation problem out there. I mean, crazy things. I know, I don't know about you, Brent, but I don't think I'm going that route. Unless you're fasting.
Can't skip breakfast?
You can't?
Oh, I cannot. No.
Yeah,
No,
no.
I've got to have it. And I got to have my coffee.
Yeah, I'm with you on the coffee. I could skip breakfast, but these are just the things that we're seeing. I mean, I know you've seen inflation, and we talk to people every day, and people write in about all the different ways that we do see it, and it's frustrating. I think many people are frustrated because your paycheck just doesn't go as far.
Oh, you're having to make choices about discretionary spending and whether or not you're going to do the latte. Maybe you don't buy the nicer brand products on the grocery shelf. You go with a store brand. Those kinds of choices are being made every day by folks just to keep the grocery bills manageable.
Yeah, I mean, I going to HEB is probably one of our biggest expenses overall. I mean, we've talked about this. A lot of people who go, we used to joke, people went to Whole Foods and be like, oh, a whole paycheck, huh? And but now that's everywhere, and it's unfortunate. And so I think people are struggling with this, and so inflation is such top of mind and something that is going to be difficult to get away from, and probably stickier, because if we are going to raise taxes, we're going to continue to spend money. That is an issue. So when we think about the overall problems that we face, yes, I think that, it's going to be persistent to some extent. Now, the problem that we're going to run into is that if we do start to see more layoffs, we do begin to see, after that, people are going to have to cut back. I mean, we've got record level credit card debt, which is now at about 24% on average. That's a lot. That's a whole lot for people to spend. So we're going to see more and more future cash flow being put towards these areas. In fact, we've had a record level of people access their 401k plan here just so far to start the year. So the majority of them, about 40%, are to avoid a foreclosure. This next second biggest thing's for medical. But we got to think about this. Lance talks about these numbers quite a bit, and we hear Lance throw a number of these things out about how many people, number one, have access to a 401k plan. Number two, how many people actually use them. So if you're taking that money out of the 401k, that means you actually have a job. You have income coming in. Think about the people that don't have access to that aren't in a 401k, that aren't working. So what are they doing? So, we've got some issues out there. So I think you have almost, we talk about almost a tale of two economies in so many different ways, and the market, the economy, what all is happening. So it is frustrating, but there are ways for you within your financial plan to do so. And if you don't have one, contact an advisor, preferably a fiduciary. We've got people that can help you here. But ideally, find somebody who's going to use realistic numbers, who's willing to go and stress it. I think that's the most important part of it. And then understanding what works for you, because it's not cookie cutter. It doesn't work. The same thing doesn't work for everybody. But we're going to get back to the qualified investment alternative option right back on the other side of this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff here, filling in for Lance Roberts. Hopefully he's gargling some salt water, maybe soaking in a tub, getting some rest. Now, that's a terrible vision. I'm sorry, you'll never get that out of your head. Gosh, dog it. Sorry for all y'all out there that I just did that too.
There was a song back in the day by Alvin Crow and the Pleasant Valley Boys called The NyQuil Blues.
The NyQuil Blues.
Do you remember
okay.
that?
No, I don't.
Give me a bottle of NyQuil, that restful sleep my body needs.
Okay.
Analgesic, decongestant, and an antihistamine.
So this is a commercial or a song?
No, it's a song.
It's a song.
A very popular song back in the day, yeah.
Okay. Well,
I'll play it for you on YouTube later.
Yeah, we may need to. Can we reach out to them and maybe we can use that tomorrow since Lance may not be here?
Probably not.
No.
No, the YouTube police don't like us doing that kind of thing.
Oh, that's unfortunate.
Mm-hmm.
Well, Lance, hopefully you'll be back. He was actually pretty bummed. He's like, we got a lot of stuff to talk about. I said, okay, what is it? Crickets. So, anyways, all good.
Well, you know what's going to happen is he's going to get this prolific writing spurt, and he'll have stuff published all over the place.
Oh, I'm sure. I mean, because he can't sit still. That's the
Right.
problem, is that he will likely not be resting. He's probably actually watching right now.
Taking notes.
Yeah. You should, Lance. You should, because I will have more likes by the end of this. Come on, guys. Help me out. If you can't tell, we've got a little bit of a rivalry here going on. It's okay. But so talking about, I had a couple questions yesterday about target date funds. And wanted to spend just a couple minutes on what that is, because, I found many people just don't quite have a really good understanding of them. And they're readily accessible in many different ways. You can use them in your 529 plans if you have children. You can use them in your retirement plan. In fact, they are what we would call the qualified default investment option for most retirement savings plans. What that means is it's the default. If you don't pick where you're going to put your funds, it'll default to either your age or your target retirement, which would be when you're 65 in general. And that is what fund they're going to put you in. And it allows the plan administrator, the trustees, to stay out of trouble and essentially say, hey, we put you in the best investment, and it keeps them out of trouble with the Department of Labor, with ERISA, all of those things that they have to be concerned with. So with them being so readily accessible, are they actually good, I think, is the main question. And if you've watched this show for long, you know that I am not a big fan of these because, number one, they are not all created equal. They are very different in nature. And I think that the expectation for most is that when you're in one of these plans, and what happens over time is that, let's say you have you can pick on a 2020 fund, is that each year you're going to get more conservative. But unfortunately, each one of these operates on a glide path that's not always the case. So you may even see a retiree, meaning that you're already retired fund, and you're still using that in the 401k, and you think, oh, that's super conservative. And when most people think of something that's ultra conservative like that, when I ask people, so what do you think that is? A lot of people say, oh, it's like a 20-80, 20% stocks, 80% bonds. The problem is, a lot of times that's more like depending on the fund, and this is where there's a variance here, quite a bit, is that it could be a 35-65, not often, but it could be. Could be a 40-60, but a lot of times it's a 50-50, meaning 50% stocks, 50% bonds. So, and nothing wrong with that. We have a lot of retirees who are actually more aggressive than that. In fact, most of them are somewhere in that ballpark, a little bit more, a little bit less, depending on the market environment. But it gives us a false sense of what they're actually doing. And actually, if you even look at the verbiage, it also gives us a false sense of what's going on as well. So I think we feel comfortable with these because, it's going to get more conservative the closer we get to retirement. But it also doesn't take into account there may be areas we don't want to invest in right now. Meaning that we may have, it's just going to blanket invest. So a lot of times they're fund to funds. So picture you're going to have a large cap, you're going to have a large cap blend, a large cap growth, a large cap value. You're going to have a mid cap. You may even have a blended growth and a value of that as well. A small cap, an international, an emerging market fund. You're going to have, all of the different types of bonds. And while that's great because it's super easy to manage, it's not great because there may be areas that you don't want to be in. We've seen what's going on in China for the last year. We've seen what's happening in Europe, where we're seeing parts of their economies, countries falling into recessions, but they're not eliminating those out of those funds. And I get it. Not everybody can be active money managers. And for some people, that's actually a bad thing. Some people, they get too active and they get all the way out or all the way in, and then they can't figure out which way to go. And so maybe something like this is okay. But, we feel like if you think something isn't going to go real well, or you don't have a long-term conviction in it, then maybe just step out. You can always step back in. But you need to have some rules when you're doing that. So the problem with those target date funds is that they're typically set it and forget it. They do slowly over time, but that glide path I referred to means that glide path down on equities and up in bonds. You need to understand exactly what that means and what that is, because it can take a whole lot longer than you anticipate, and it may not be exactly what you think it is. Now, we've seen a humongous uptick in target date funds. So, in fact, coming back from the challenges of 2022, a Sway Research report reported that target date funds surged an unprecedented $3.5 trillion in assets under management by the end of last year. So, 22% uptick. And I think what that may be is that some people are just like, oh my gosh, this market is crazy. I don't know what to do. This is the easy thing. It feels good. It feels safe. I'm going to put the funds here. And I get it. Markets are frustrating. There's a lot of frustration out there. We get calls every day with people who are frustrated saying, I'm over at XYZ. What do I do? They haven't touched this thing in over a year, 2 years. I can't remember the last time we made a change. I understand. But these target date funds aren't a lot different either. And they're also, we have to be cautious of what those internal fees are. So depending on how they're set up, a lot of times they're fund to funds. So each one of those mutual funds has their own internal cost, and then they're going to wrap a cost on top of there. Now, they've got a little bit better about bringing those fees down. So I've been encouraged there. So I told you I'd give you some some pros. I think it's getting better. It's still not good for something that's not really ever touched. But I understand why people use them. That would be my other pro, is that I understand. It's challenging. It's frustrating. But you can do better. But you got to empower yourself with some knowledge. And it can be difficult. I know, many people, I talk to people all the time and said, listen, I just don't have the time to keep up with it. It's paralysis by analysis. There's so much information out there. I'd rather just not even worry about it. I'll just set it aside. And I haven't looked at, or we get those phone calls to say, I haven't looked at this thing in years. Which, if you're an accumulator, great. I mean, you're putting funds aside, fantastic, but you've got to be careful there. So, we talked a little bit about how we were going to talk about some spring cleaning. Yesterday was the first day of spring. And one of the things you can do, go look and see what are you invested in your 401k. Because I do think it's that important, especially when we're looking at more volatility. Like I mentioned, 18th high for the year. Your portfolio may not be feeling that unless you're just in the S&P or the NASDAQ or maybe a Dow fund, which isn't even, many people don't have access to that. It's not as commonly used. And preferably, we'd rather use the S&P as more of a benchmark for stocks in general. Anyways. But those tech companies are still, really the ones that are driving the market in general. So when we think about investing, we need to be cautious. Do you take some profits in certain areas? Do you relook and revisit this? So if you're going to do, the first thing for spring cleaning that I would do is take a look at that 401k. Have a good understanding as far as what your investment options are, what you can do, what are the costs for them? Is there a similar alternative that maybe you have a mutual fund and you have an ETF and they're almost identical? I see that often. Go find, if that's the case, go use the cheaper one. Save a little bit of money. And I think the problem with that is that when we look at those, most people don't look at expense ratios because they're not out there in black and white. It's not the first thing that you see. I think they're also talking about pros. I think they are getting a little bit better 401ks showing those expense ratios. But if you've got the same thing, go use the cheaper option if it's available. But if you have questions on any of that, go to realinvestmentadvice.com. We're always happy to help answer any questions. Please don't take any of this as the gospel. I mean, we're just talking about things that we see, things that we do. Doesn't mean it's necessarily good for you. Everybody's plan, everybody's investments are a little bit different. But do me a favor, go hit the like button if you're on YouTube. Like I said, got to give Lance a hard time. Hopefully he does feel better and he's back in the saddle tomorrow. Thank you guys for putting up with me today. If you are in Houston, you have time for lunch, we'd love to see you. Savvy Social Security Planning for Couples today. One spot left. We got scammed by bots. Our what do we call that, Brent? Anyways, our misfortune is your gain. Hope to see you later. Have a great day. We'll see you tomorrow.